Markets are continuing to feel the impact of the Israel-Gaza war. We did see yet another move up in U.S. bond prices, people seeking out havens, not safe havens, that's redundant, havens. Oil, we have, of course, seen it moving up over the past week. How should you structure your portfolio amid the risk that this conflict will spread? We're joined by Alexander Macdonald, portfolio manager at GlobeInvest Capital Management. He's right here. Thanks.
Morning, Andy.
John Alders, the Bloomberg opinion columnist, is arguing that the markets almost seem a bit complacent about this thing.
Yeah, so unfortunately, nobody knows how this conflict is going to end. If we rewind a little bit, geopolitical tensions were already quite high going into this, of course, with the war in Ukraine. And as a result, defense budgets were already quite elevated. So it's sad to say, but we've sort of seen this for a couple of years now already. With defense budgets being up where they are, as it plays out in the investment sector, it's hard to sort of see more spending being poured in, at least in the short term, especially on the U.S. side. The U.S., as we've seen in Ukraine, has been a little hesitant to get involved directly. And now in the conflict that we're seeing in the Middle East, they're also a little hesitant to directly get involved in there as well, too. That said, it should provide some floor to some of the defense spending we've seen recently. I can't see budgets being cut too considerably. But then you do have some of the political dysfunction we've seen in the United States as well, too. And then they have the budgetary issues. So there's a number of things at play as this applies on the investing side. And unfortunately, just nobody knows exactly how it's going to play out at this point.
Raytheon, though, is a name you own in defense.
So Raytheon we've owned for a while now. It's about half defense and half commercial aerospace. Unfortunately, it's had a bit of a hiccup in the past 6 months or so. It's got into some issues with some of the powdered metal it uses in manufacturing jet engines, specifically the jet engines on the Airbus A320. So it announced back in July that it thought it was going to have to do a bit of a recall to inspect these engines, and then subsequently in September elaborated that the recall was going to be a bit more intense and a bit more costly than it thought initially. It's quantified this expense at about between $3 and $4 billion on a cash flow basis to itself. But then when you look at how the stock has performed since this news has been released, the market cap's down by about $30 billion. So there's quite a margin of safety in there, we think, in the current valuation that already discounts quite a bit of this negative news for Raytheon specifically. That said, there are some additional risks the company could be facing. They don't know, exactly how this powdered metal, how many engines specifically it's affected. Has it gotten into some of the other engines outside of the A320 that it provides parts for? Mm-hmm. Is this recall going to be more costly than they originally thought? Are the inspections going to take more time? And then subsequently, does this affect their brand? Are customers going to be less likely to use RTX? Pratt & Whitney is the brand that makes these engines. Are customers going to be less likely to use them going forward?
Of course, I called it Raytheon. I'm out of date. I should have called it, it's now known as RTX.
In fairness, they changed their name a couple months ago, so I still do the same thing.
Gold. You're not a holder of gold.
We don't own gold. So, the common saying on gold is it's sometimes an inflation hedge, it's sometimes a haven, as you pointed out. Depending on the time period you pick, that either is true or isn't true. So if you look at, specifically it as an inflation hedge, we've been in a pretty high inflationary environment here for a couple of years. And gold in US dollar terms is basically traded sideways. So it hasn't hedged on that front. And then in terms of it being a haven, again, you can make the same arguments depending on whether you think, we're in a period of conflict now or not. Again, it's sort of traded sideways. So gold doesn't create any free cash flow, which is when we invest, we like to buy companies that generate cash flow that they could invest and potentially return to investors. But I think something like only 10% of it is used for industrial purposes. So it's really either used for jewelry or it's self-fulfilling, used as a speculative or investment product. So we haven't been active in the gold space. Don't see that changing going forward. But, I do know there are a lot of people that, it's had a 400-year history of being around as some sort of currency. So some people may disagree with that.
Yeah, it's interesting. I always wonder, why don't they pay dividends? They own big dividends. They own gold mines. Yeah. And the South African players used to. But I've heard it said investors in gold don't care about dividends.
Yeah, they care about reinvesting more mines, finding more gold. Reinvest when times are good, and then some of them have squandered it when times are bad. So the capital allocation has not been great amongst some gold miners.
Lululemon moving to the NYSE. It's not a holding for you though right now.
It's not, so being added to the S&P 500. So because of that, a lot of the demand, you'll see people having to go in and buy because it's going to be added to ETFs and so forth. We don't, in that space, we don't own Lululemon. It's been a great company. It's done a great job. Fast fashion's a really tough business to operate in. Every quarter is a new season. Customers, they're thinking, what have you done for me lately? You'd have to constantly come to market with new products that they're going to want to buy. Lulu's done a great job of that. We just don't think the growth prospects are as attractive as a name we own, and that's Aritzia, which we think has amazing growth prospects in the U.S. going forward. They've barely stuck a foot in that market so far, and the stores they could open there going forward, I think, are going to provide some pretty substantial tailwinds for them.
I got mixed up there. It's joining the S&P 500. You were too polite to point that out. It's not actually going to the NYSE.
Yeah.
Thanks very much. But of course, apparently research shows that sometimes after a stock is added to an index, it can underperform.
It's possible, yeah. I mean, generally you see some net buying demand for it there because people that didn't own it previously, they have to go and purchase it. But I mean, it's certainly not a sure thing. I mean, depending on what's happening in a given environment, that could not. It's not a hard and fast rule.
You reckon that short-term bonds are looking more attractive?
Yeah, so if you look at the yield curve, it really does start to come off post sort of 1 year to the 10-year mark. And we sort of think the sweet spot where we've been buying bonds recently is in that 2 to 3 year range. You're still getting some pretty attractive yields, and you are locking it in for sort of a medium range period of time. 1 year is really not that terribly long, and then once you go past 3 years, you're not necessarily getting paid to take that duration risk. So investment-grade corporate bonds are where we've been active more recently, buying for clients, and yields right around now are up around 6%. So we think that's pretty attractive, especially when you look back sort of over the last 15 years or so when bonds were hardly yielding anything.